Hello everybody. Today in this video, I'm going to share with you how I nearly lost $100,400 in one morning, all because I misunderstood secured puts. And I'll break down exactly what went wrong, the lessons that I learned, and how you can avoid making similar mistakes in the future. So let's get into the video. Number one, how my day started up to the point when things went wrong. Two, what are cash secured puts and why I got bent. And I'm going to explain a little bit about margin accounts and the hidden risks that comes with trading in a margin account. And fourthly, the trading rules that I will never break again, having learned from this experience. And lastly, final thoughts on how to stay safe when you are trading. Now let's get into it. At this point, I almost lost 100,400 Canadian dollars in a blink of a second, right? But sometimes if you do manage your risk, you can make money. So what I'm doing here, I am doing real trades. This is real money. So each time that you are trading or investing, always understand the things that you are doing. And this video should not be taken as investment advice, as investing comes with risks as much as trading. Now, I started my day in a very jovial way, and I'm recording this video on April the 8th, 2025. And I had cashed out 456 US dollars from my profitable trades, and what was actually a very good day. And I was about to head out to the gym. Then I saw an alert. Intact Financial Corporation had dipped to what I thought was a level that I could not miss, the entry level. Now, let me just go on the chart to provide you a context on my technical analysis. But each time that I'm trading, the first thing that I want to do a deep dive in the stock, fundamental analysis to understand their balance sheet, their free cash flows. I did that. I was comfortable holding this stock, even if it dropped. Now, let me show you the technical analysis for my reasoning. For those who don't know what this platform is about, this is a trading view chart, and basically it shows you the charts. I do technical analysis after doing fundamental analysis to get my end level. And what you see here is this dark or gray, I'm colorblind, guys, is the demand zone and the supply zone. And demand zones usually stocks, they come to this level and then they go up. It's not guaranteed, but when I am doing my analysis, I like to understand this stock, like I said. But you can see this stock, if I look at this point, this was around, let's say, September. This stock actually, from September, it went down, it went up by, in this case, you can see that it went up by 33, almost, let's say, 34%. So this stock is actually has been on an uptrend, and it's a fundamentally strong company. How I got to know about this stock is for my business insurance I use them, and each time that I go there, they always provided good service. And I then did a research. They have insurance business in the United States, in Canada here as well, and also in Ireland. And they are very good in terms of their balance sheet, cash flow management. So after I then saw this, I then decided to say, look, what if it pulls back? Still, this is a business that is very strong. If it pulls back to 260, I would be comfortable to buy because there is this demand zone. Now, the risk is that if it comes down here, which is something that is probable, but in my analysis, I thought, you know what, this was good. Anyways, my plan, like I said, I only wanted to just sell one cash secured put at a strike price of $260, like I showed you, expiring on April 17th. And the idea, I was going to collect a premium. Let's say in this case, $100 in premium. So if IFC stayed above 260 by the 17th of April, my technical analysis suggested that in this case, right, it could be possible, but I could be wrong. But I would keep that money. But the problem came when I messed up the bid price adjustment. Instead of one contract, I accidentally submitted 4 contracts, and one contract has 100 units, in other words, 100 shares. So what this means is that for 4 contracts, that would have been 400 shares. And that's how, it would have amounted to $404,000 if I then subtract the premium that I had gotten. Now, by the time I noticed all the 4 orders had been filled, my account was now on the hook for 104,000 in collateral. Now my heart sank, but I had two choices to make. Number one, to hold and risk the assignment. IFC stock crashed, I would owe $260 a share times 400 shares minus the premium that I got. 2, close immediately and eat the loss. In other words, take this loss now and avoid this, I would say, cataclysmic, disastrous loss in this case. But you know what? I chose the latter. I took the 380 Canadian dollar loss to avoid the potential disaster. And I was checking, as you saw, the stock had actually retraced even lower. So what that means, my loss in this case, if I hadn't realized it, it would have increased. Now, for those who don't know what secured puts are and how I got bent, number one, let's rewind. A cash secured put is when you promise to buy a stock at a fixed price, that is the strike price, by a certain date, and you get paid premium. But if the stock drops below the strike price, you are then obligated to buy it. Even if it goes to zero, you are then obligated to buy it at that strike price. So that's where the risk is. And that's why it is very important. In my case, I like to play stocks that have strong fundamentals, but also stocks that have strong fundamentals, but that are cheap. Like SOFI, for example, even if, let's say, if I have 1,000 shares for SOFI, right? And that would be 10 contracts. If it goes to zero, I got in at $10, that would be $10,000. Compare it with Berkshire Hathaway, let's say it's $500 a share. So that means it's 50,000 for 100 shares. And if I had 400 shares, it means that would be $200,000 loss. That's the kind of losses that would force you to go broke. And that's why sometimes you see a lot of traders, they make mistakes and then they are gone. Statistically, 90% of traders, they actually go broke within the first 90 days of their trading career. And then that's it, because sometimes people want to take a lot of risks. But now, back to my case, the Intact IFC, that's the ticker name, it had a wide bid-ask spread on the Toronto Stock Exchange. And when I tried to adjust my order, the illiquid market amplified my error. That's why I like to stick to high quality US stocks. And even in Toronto Stock Exchange, I like the stocks that have narrower bids, spreads, and tighter spreads. In other words, it means fewer surprises. And for those who don't know, a bid price when you are trading is more like the buyer. You always want to buy cheaply, right? So usually buyers, they want a lower price, and sellers, they want a higher price. And there are big institutions that can actually make money. Let's say if you're looking at Wall Street or Main Street in Canada, what then happens is like they can buy at a lower bid price and sell at a higher ask price. And if you have, let's say, 1 million shares and it moves by $1, that's a $1 million trade minus fees and taxes, of course. So that's how some people make money. So in this case, each time that I want to take trades at Toronto Stock Exchange, that's something that I notice in most of the stocks that I've been following. Now, I'm just going to quickly explain what a margin account is. For those who don't know, you would say, wait, why did I need $104,000 in my account? Because brokers require cash collateral for secured puts, because you're saying it's a cash secured put. You're saying if this stock, are you agreeing, you are obligating yourself to say, okay, if it drops to this level, I'll buy X amount of shares. And if that happens, then you're supposed to buy it. So what happens is, in my case, I like to trade with a margin account, even though I strictly want to trade with the cash that I have. But at some point now, I use Quest Trade. They've improved their platform. They would take what they call the T+1 rule to say, look, if I wanted to make 10 trades, like I would buy and sell, right? Let's say $10,000 trades. But if I only have 20,000, I would just do two $10,000 trades, and that's it. But if I have a margin account, I could still buy and sell up to, let's say if it's 100,000, I could do 5 more trades, 10 more, 8 more trades. And for those who have been following this channel, that, my account now, it has grown almost to 25,000 Canadian dollars. So I was comfortable to say, look, if I'm assigned at 26,000 minus the premium, it's going to be maybe like, it's going to be a cash position, because the risk of a margin account, it's basically you're borrowing money. In this case, I have a tax-free savings account. In Canada, we have registered accounts, and the margin account is an unregistered account. So what happens is, like, for the stocks or the cash that I have in the tax-free savings account, it's more like a collateral. But what happens is, if my stocks or securities in, or my cash balance in the tax-free savings account drops at the same time as the stock in the margin account, right? You would be forced to actually sell for the margin account, because you have to cover, it has to be at that level. So I don't ever want to get to that point. And I remember this story by Warren Buffett in one of the interviews, saying him and Charlie Munger, there was another guy, I forget his name, they were genius and they used to trade, but the other guy was impatient. And what happened was that he wanted to use leverage a lot. And what happens is, if the market drops unexpectedly, now if you have stocks that are not investment related, in other words, if they drop or they go in a downward spiral, it means you'd be forced to even sell, liquidate the stocks at that point. But usually what happens is, as soon as you sell, it goes up. But margin account, they will say, okay, you have to liquidate this, or if you don't, the broker will just liquidate them at, let's say, in an hour or in a day. So I don't want to play those kind of games. When I'm trading, it's not gambling. I really want to be responsible when I'm doing this. That's why I use the margin account, but I stick to the cash that I have. Now, always double check the buying power before hitting submit. Because if it's too tight, then if the stock drops a little bit, then you get a margin call. I don't like that. I want to sleep peacefully. Now, the trading rules that I will never break again. Number one, this mess taught me 3 non-negotiable. Number one, trade size rule. Never risk more than 5% of your account on one day, right? You don't want to ever risk. They also have a lot of cash on the balance sheet, and all these assets, cash and secured equivalents, even if the stock was unlikely going to drop to zero, in my view. But I could be wrong. So the risk is more like, each time that you get out of the house and you are going out you're driving, there's a probability that you can go and be involved in a car accident. But sometimes with experience, things can happen. The probability is there, right? So that's the way that I look at it. If my car is fully serviced, I've done due diligence, I drive carefully, but still there could be a drunk driver who comes and hit you. In this case, in the parlance of the stock market, let's say there's something like the trade war that is happening or something, the stock might just drop. But if I have the cash, I can just hold. That's the idea for the long term. And if it's not something that is cooking accounts, like fraudulent accounts, usually those ones, they are serious allegations that can, cause the stock to tumble. Rule number two, liquidity first is very important. I always, as a rule, only want to trade stocks that have high volume and narrow spreads. Most stocks that I trade, like Palantir, for example, Nvidia, and Tesla, they have very wide, they have high volumes. You get in, you get out, and the spreads, they are not usually high. In this case, like I said, I was still profitable if I had gone on the bid price. I think it was like $40. When I am trading, I want to sleep peacefully. Each time that you feel you're in a trade and you feel like, I'm not comfortable here, you are not sleeping peacefully, it means you are taking excessive risk. And that's one way most traders lose money. I want to grow my account. If I make $400-500 a week or whatever the market gives me, that's it. I get in and I get out. Like in this case, I'd made just over $450 and it was a good day for me in this particular account. But then you see what happened. Number three, I want to do my pre-trade checklist. Always verify contract quantity and the strike price before executing. As you can see, if you have seen, breaking these rules cost me $380. So don't let it cost you more. I could have potentially lost. However, highly improbable that could have been. Like I said, taxes and death, they are the two things that I consider to be very certain. The probability is one that I'm going to die at some point. The probability that I will pay taxes is one. Then my final thoughts and how to keep safe after this. Of course, in my case, I'm fortunate that I'm trading this and it's obviously in the margin account. That's money that I'm comfortable losing. If I lose, I will, of course, it sucks, right? But of course, my goal is to grow the account. But I don't want to risk this. This is my trading account. For my investments, those are long-term holds, and I don't trade in those accounts necessarily. Now, mistakes happen, but how you handle them defines your trading journey. If you take one thing from this video, or if you are to learn one thing, risk management isn't optional. It's a must. You must manage risk. I'm fine in terms of the net. I still made profit at the end of the day in terms of my realized profit, right? If you convert it, I was profitable in that regard. But hopefully, if this helped, smash the like button, subscribe, and ring the bell so that you don't miss future lessons. Drop a comment below. Have you ever made any trading blunder? I would love to hear from you and also learn from you. Thank you so much.